Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Streamline Capital. Very excited for today's show. We have none other than Senate Eskridge on the line with us today. So, Senate, welcome.
Ryan, thank you so much for having me. I'm excited to be here. I think it's been, I don't know, a couple of years since we had a
Yeah.
conversation on your podcast. So I'm
Yeah, I
excited.
know this isn't the first. We see each other, fairly regularly because we're what I call Idaho close, Twin Falls to Idaho Falls. It's what, 200 miles? That's close in Idaho.
Yeah,
Yeah.
2.5 hours, something like that.
Yeah, it's probably less than 200, but it's
Yeah.
more than one. So anyway, Senate, do us a favor. Tell us a little bit about yourself and how you got involved in real estate and then multifamily.
Wow. That's there's a lot to say there, so
Yeah.
I'm going to start with the end where I am today, and I'll
Mhm.
tell you the story. But today I focus primarily on two aspects, right? So I help people invest in real estate and other private equity investments,
Mhm.
usually through the fund of fund model. That's really
Okay.
where my business has evolved to at this point. And I
Right.
also do a lot of education, a lot of teaching. I
Hmm.
teach people how to do what I do, how to do what I've done
Hmm.
on a one-on-one basis typically, right? So I don't have a big program like yours or anything like that,
Hmm.
but I teach people one-on-one,
Yeah.
how to achieve their goals.
Yeah. I
So
know you've been doing like the meetups and all types of stuff like that since I met you at least. So in your meetups, even in a small town, you get a pretty good following, which is difficult. So good on you for that.
yeah, it's a lot of work, labor of love. Like I said, I love giving back and teaching, and so that meetup is one of the things that I do. To be able to do that, we meet once a month here in Twin Falls, Idaho, and usually we have a different topic of discussion, but it's all about just giving back to the community.
Hmm.
That's the key.
Yep.
Um,
Awesome.
but like I said, I didn't start here, right? So you
Hmm.
asked about the story, and I'll give the abbreviated version. But I've been an entrepreneur my entire life. I had a couple of corporate jobs, but I was never a corporate guy. It just didn't seem to be a fit for me. The thing that I did for the most of my entrepreneurial journey was
Hmm.
to be a financial advisor. I help people with stocks, bonds, mutual funds, lots of life insurance. Luckily, I'm not in that business anymore. I hung up all my licenses. I don't have any of
Yep.
that anymore. I threw a party the day those licenses expired. During the whole time of doing that, I was investing my money in real estate.
Hmm.
Right. So I did a lot of things in the single family space. From 2009 to 2019, I was doing single family fix and flips, long-term holds, did the Burr strategy. I bought things from wholesalers. I did wholesaling. I did a little bit of everything in the single family space. And I built a really good portfolio, right? And I'd done more transactions than most realtors in my town.
Yeah.
And I'd never been a realtor and, never really been a wholesaler. Did a little bit of
Hmm.
wholesaling, but never been a wholesaler per se.
Yeah.
But it was so transactional and I just got so burned out. And
Hmm.
so in 2019, I started exiting my financial services practice and started
Hmm.
selling all my single family homes and moving everything into
Hmm.
multifamily. Did that for a couple of years and then figured out I was going to run out of my own money, right?
Hmm.
Because I only had a little bit, right? I didn't have a whole
Yeah.
lot, but buy one or two assets and now I'm broke. So that's when I discovered syndication, right? And syndication just blew my mind. And where I can go out and I can buy a 200 unit apartment building using almost all somebody else's money. And
Yeah.
it really just changed the trajectory of my business. And I did that for a couple of years, and I still do that, right? I'm
Hmm.
still constantly buying my own deals, especially right here in Idaho. I love investing in Idaho. It's absolutely a phenomenal place to live and an even better place to invest.
Hmm.
But the challenge is there's not enough deal flow to keep my investors happy.
Yeah.
So I'm also raising capital for other people through the fund of fund model. And that's really good because it gets diversification for my investors,
Hmm.
right? The next deal I'm going to come out with is an oil and gas deal. Well, I'm not an oil and gas expert, but I'm
Hmm.
partnering with oil and gas expert,
Yeah.
somebody who is an expert that knows exactly what they're doing.
Hmm.
And so I can now bring that diversification out to my investors.
Awesome.
And still doing some coaching and helping people, but that's really
Mhm.
the evolution of my business.
Awesome. Awesome. Now, if I remember right, we're both in Idaho, but I met you in Orlando at a Jake and Gino event. Were you in that Jake and Gino program?
So, when I did the single family stuff, like I was
Mhm.
talking about, I did all of that on my own. I never joined a
Mhm.
mentorship group. I never had any paid mentoring at all. I listened to podcasts and books and things, but when I decided to go into the commercial space, I went in on mentors. And
Yep.
I've actually been a member of several paid
Mhm.
mentorship groups. right? Some that are in
Yeah,
the
me too.
lower monthly cost,
Yep.
that I pay for on a low monthly basis, and some
Mhm.
that I had to pay tens of thousands of dollars to get into. And
Yeah.
that is one of them. I was a Jake and Gino student for a long time, and then I actually became a coach for them for a couple years and coached alongside of them.
Okay.
And I helped someone else launch a coaching program. I designed it for them and built it for them.
When I put together my coaching program, oh my goodness, there's a lot of work getting those things off the ground and launched, But you said you help somebody. Are you still affiliated with that program or just help
No,
them and give them a good push?
it was a short-term deal, right?
Mhm.
I was contracted to get it up and off the ground and built and designed,
Okay.
and then once that was all said and done, we parted ways. And
Hmm.
now currently, I don't have any kind of a program necessarily.
Hmm.
What I do is one-on-one customized coaching for people.
Hmm.
So somebody comes to me with figure out where they're at, what their goals are, and then I
Hmm.
figure out how to get them to where they're going one-on-one.
Nice. Awesome. Awesome. Well, you got a lot of experience being coached and coaching. I think I learn as much about coaching from being coached than I do from anything else, So every dollar I pay for coaching, makes me a better coach in the long run, is what I've found. But and then every dollar I pay for coaching, that's the best return on investment of anything I've ever done is coaching. But
Absolutely.
so cool, cool. So let's start unpacking a couple of things. You said so when you were in financial planning, you said you started investing in your profits into real estate. Let's talk about why you picked real estate and kind of what the typical deals were, and then we'll just kind of look at the progression. And what I really want to focus on is just kind of like why you decided to do certain things and why you decided to move away from certain things. So start with that first, and then we'll move on.
My first real estate investment was a single family house, and it was an absolute accident. So
Hmm.
I had a house that I lived in that I needed to move for different
Hmm.
reasons. And so I bought another house in a different town. And when I tried to sell the first house, I couldn't sell it and no one
Hmm.
was buying. So what do you do with a
Yeah.
house you can't sell? You rent it out. I was making about $250 a month in cash flow. And
Hmm.
I'm like, wow, I can go do this again. My second one was I went and bought another single family house. And
Hmm.
I luckily was in early stages. I qualified for like first time home buyer, down
Hmm.
payments, and all that kind of stuff. So I had really low amounts of money at first. And so
Yeah.
that was the reason that I did that was because I could get into duplexes or triplexes for a really low amount of money down,
Hmm.
and then I could generate cash flow on the back end. And cash flow was really important to me, stable, consistent cash flow. The thing is I didn't realize that every single house that I bought was buying myself a job.
Yeah.
And I mean, it took me a few years, right? But it didn't take me a long time to figure out that I was working more time with my passive, quote unquote,
Hmm.
passive real estate investments than I was on my full-time job. And it was a good paying job. I was probably averaging about $50 an hour. So it was good pay, but it was still a ton of work and it was a
Hmm.
job.
Yeah.
And so that's also the reason I stopped, right? I was like, oh, I can't keep doing this anymore. I can't scale. I don't have enough time in the day, right? I have a full-time business, financial advising. I have
Hmm.
my passive real estate that
Hmm.
is a full-time job.
Yeah.
And I've got this amazing wife that I love, and I have five beautiful children that I
Yeah.
want to spend time with. And
Yeah.
so I had to do something different.
Yeah. Yeah. Absolutely. And I think a lot of people, when they start, and you use air quotes, I'm going to use air quotes as well, investing in real estate, what they're actually doing is creating a job. It's a little bit of both. You've got to manage your portfolio, but when you're buying single family homes, somebody has to manage it. And a lot of times that somebody's you. Even if you get a property management company, they're still coming to you to solve the big problems. But as a matter of fact, syndication is also a full-time job. But some people don't
Yes.
realize that either. But so you started doing the single families, the small multis, and everything. What got you from there into syndication? Just go in a little more detail there about, why you decided to go into syndication and then how you started doing that.
Well, my very first foray into multifamily,
Hmm.
big multifamily, I actually found an apartment building. If somehow it ended up on the regular MLS, I don't know how it
Yeah.
happened. And it was a $10 million apartment building.
Okay.
And before I had any coaching, before I even knew what I was doing, I
Hmm.
called my single family realtor that I use to buy single family houses and sell single family houses. And I said, I want to buy this building. And I sent the listing to them. And I said, write the offer at this price with these terms and all this other kind of stuff. And I
Yeah.
did it just like I would a single family purchase.
Hmm.
And I can now, today, I can see what the seller thought, right? I mean, it was a joke. The realtor wrote it on the single family form, and the terms were like, I don't even know. I had like $1,000 of earnest money,
Hmm.
close in 30 days with a mortgage similar like a single family house, right? I
Yeah.
mean, and I just got laughed out of the room,
Yeah.
which is good because I wouldn't have known what to do with it if I did buy it.
And looking back at it, my first offer was very similar. Well, it wasn't a $10 million, it was like a $5 million property. And, I got laughed out of the room because I had no idea what I was doing. But yeah, I'm laughing at you now because I did the same things.
It's interesting how we start. That's the moment that was like, aha, I've got to learn how to do this.
Yeah.
That is when I decided to join the coaching
Hmm.
program we talked about earlier.
Yep.
And so I took the money that I was going to put down as my investment into that
Hmm.
deal, and I decided to put it all into coaching.
Hmm.
And so I've now been through 7 different paid mentorship programs,
Hmm.
that I paid significant amount of money for.
Yep.
And I took a lot of time to learn and to learn everything that I possibly could. I read every book that had ever been written on the
Hmm.
subject of multifamily and syndication. I mean, you see, I've got quite a few books behind me. Most of them are about that. And then my first actual deal that I ended up buying, my partner brought me this deal and said, "Hey, I found this. I don't know how to buy it. Will you help me buy it?" And
Yeah.
so I structured an owner carry deal with the seller, and we were able to put down just 20% down
Hmm.
with an owner carry deal with great financing terms.
It's not
And
bad.
we
Yeah.
still own this one today.
Hmm.
There's a total of 7 partners in the deal. It was a joint venture. It was kind of my first capital raise, too, even though it wasn't a syndication, it was just a joint venture. But I
Hmm.
had to get out and strum up all these partners to get this
Yeah.
done. And like I said, we still own it today, and it's one of my most profitable assets.
Nice. Now, is that local to where you're at
Yeah, yeah, it's
okay.
right here in the city I live in. So it's
Okay.
a mile from my house. 18 units. When we first bought it, the rents were around 350.
Gee.
Uh,
Wow.
so in 2020, they were about 350 per
Uh-huh.
unit. Now we're just right around 1100 a unit.
Okay. Interesting. Now, was that 300, 350? Was that below market rent at the time or was
Yeah, it was way
okay.
below. Market was probably around 750, 800 at the
Okay.
time, but they needed some work, right? And
Hmm.
so we had to get in there and put in some elbow grease. It was
Yeah.
a value add deal, right? So paint the outside, clean up the interior units. We redid most of the bathrooms, several of the rooms, put in an internet system, camera system,
Hmm.
new HVAC system, things like that. Actually, one of the worst stories. So when we first closed on the deal, we went in
Hmm.
and met all the residents, and they said, "Are you going to fix the hole in my bathroom? It's been there for 3 years." And I said, "There's a hole in your bathroom. Like, where's it at? Tell me about it." And
Hmm.
she said, "Well, the other day I was out of toilet paper, and I asked the neighbor for some, and she handed me some."
Oh my goodness.
It was not a pretty building when we bought it,
Yeah.
and now it's absolutely stunning, beautiful, and the residents love to live there.
Yeah, it's amazing, what you can do with buildings that have been neglected by owners for a long time. It's especially if you buy them in a good area or close to home. There's just a lot of potential, a lot of meat on the bone for that stuff. So, well, awesome. So that was your first foray into multifamily, not technically a syndication. What was next for you? Did you jump into syndications after that, or did you do a couple more that size first?
Yeah, I did a couple more that size.
Okay.
I've got one in Burley, the other one in Twin Falls that are in the smaller, 20, 25 units in that
Yeah.
range
Hmm.
that I just did with a couple of partners.
Hmm.
My first syndication actually is up in your neighborhood. We've talked about
Hmm.
the property before. It's a
Yep.
33 unit in Pocatello
Yep.
that I bought for 3.3 million.
Hmm.
And so we syndicated that one. The entire capital raise was $1,090,000.
Okay.
And I learned a ton about the syndication process and how to actually
Hmm.
file. This is when I started learning what's the difference between a 506B and a 506C and,
Yeah.
blue sky filings and all that kind of stuff. It was such an amazing thing. People think that they can just throw like a joint venture agreement together and do a syndication, and it's not the case. It's
Not quite. Yeah.
it's a ton of work, right?
Yeah, it is. So what were your biggest lessons learned on that first one?
Yeah. The biggest lesson learned, get educated before, right? Don't try to do something without your full education.
Hmm.
And the second one is raise the capital you need
Hmm.
before you need it.
Yeah.
So, and what I mean by that is build your investor pipeline, build your database, build your CRM. And
Hmm.
so that when you have a deal, you know exactly who you're going to call and
Yep.
who you're going to talk to. So I'd already exhausted most of my friends and family and all that kind of stuff with these little joint ventures I've done.
Hmm.
And when I needed $1 million, I called my sister and she said,
Hmm.
Senate, I've given you all my money already.
Yeah. Yep.
I'm like, oh,
Holy
okay.
crap.
So
Yeah.
it was a lot more work than it needed to be.
Hmm. Now, how many people were in that syndication?
27. That includes all my general partners. I've got three partners on the deal. So
General partners and limited partners,
yeah,
27.
27 total.
Wow. So $1 million between three general partners. In my first syndication, we had a $2 million raise, and there was four of us. And I didn't have anybody, to call. I ended up raising 400,000, but it was all because of hustle. But I wholeheartedly agree with what you said. Before you get something under contract, you need to have a pretty good idea of who's going to invest with you, a pretty good idea of how much money you can raise. And I'll take it one step further. You should only be putting offers in on properties that kind of fit that criteria. So if you and your four partners can raise $1 million, that should inform, what you're putting your offers out on. But I wish I would have known that first. 'Cause we put an offer in on a $4 million property. We were going to come in with like a $600,000 CapEx budget, almost a $2 million raise. And it came down to the last second, getting that done. But anyway, I actually drained my entire savings account to get that deal across the finish line. But that's a different story.
Got it across the finish line. That's what
We got it
matters.
across the finish line. Yeah, I put in, I think, 40,000 more than I wanted to, but we got it across the finish line. And that property sold 2, 3 years ago. We did well,
Nice.
but man, it was rough. So that was the first syndication $1 million capital raise. Take us from there. How do things progress from there?
Yeah. So
Mhm.
after that, I was introduced to
Mhm.
through my coaching programs, right, to other people that deals in other areas. And I
Mhm.
started working in the co-GP model,
Yep.
which I've done several deals with that model.
Mhm.
And, I've got deals now in several states. I've done 27 syndications
Mhm.
of various sizes and locations. I've got assets now in Idaho, Texas, Oklahoma, Ohio, North Carolina, Arizona, Utah, Montana.
Yep.
And, the biggest one in my portfolio is 176 units.
Okay.
And the smallest one that is a syndication is that 33 unit we were talking about earlier.
Yeah.
What I really learned in this is I can get access to really high quality investments by working with other people that have, boots on the ground and ability to buy in other markets.
Yeah.
And the other thing that was really cool for me was it gave me the ability to work on those bigger assets that I couldn't do on my own.
Hmm.
Because you alluded earlier, right, to how much capital can you raise? That
Yeah.
controls the size of the deal you do. But
Hmm.
another thing that you didn't mention that controls the size of the deal you do is your net worth, right? The net worth of your
True.
team. Most lenders will only lend up to your net worth.
Hmm.
And so for me to go and do this 170 some odd unit, right, my net worth would have had to been much higher. But now that I'm partnering with somebody that can do the deal,
Yeah.
now I'm going to sign up for an allocation of what I'm going to raise,
Hmm.
500,000, million, whatever I can do. I can get a piece of a much bigger pie. And so that is something that is really helpful to me too, right? So I still buy
Yeah.
my own deals, but I'm out there looking for other deals as well.
Yeah, and that is one of the benefits of partnering is my money by myself, I'd have a couple single family homes. Well, I'd have more than a couple. I mean, I had a couple when I started this, but I'd probably have 6 or 8 single family homes if I was using my own money on all of this. But when you start partnering, you can leverage other people,
Hmm.
and other people are leveraging you at the same time. And it's,
Absolutely.
it's that synergetic effect that really helps out. So you got into a couple of deals doing that. Now, something I definitely want to talk a little bit about is you mentioned the fund of fund models. So before we talk about what that is, why did you decide to move from like the co-GP syndication to the fund of funds? And I should ask this, was there an intermediate step between the two? Because I may be fast forwarding a little bit too quickly.
It's an interesting conversation. So
Yeah.
I had a big operator that is very famous in our industry, right? That I
Hmm.
won't will not name his name, but he's a mad scientist. Said, hey, do you want to help me raise for this deal?
Yep.
Literally just solicited me. Do you want to help me?
Yep.
And there's no way that I could have been a co-GP,
Hmm.
right? Because he already has this big structure and this big system and all that kind of stuff. And as you know, but just so we all the listeners know, if you're going to be a co-general partner, right, you have to do something else besides just raise capital. The SEC frowns on people getting paid to raise capital unless they're licensed.
Hmm.
And so if I wanted to raise capital on this deal, I would have to have a job
Hmm.
to be a co-GP. And there was no job for me to be had.
Yeah.
And so that was my first question was, well, I could raise 500,000 for you, or maybe even 1 million, but what's my job?
Hmm.
And he's like, oh, no, call these people over here at TribeVest,
Hmm.
and they're going to set it all up legally for you.
Hmm.
And I'm like, oh, okay. And so it was a fund to fund, but it wasn't intentional, I guess. Somebody else
Yeah.
brought me that concept. And so I learned how to do that through that model.
Hmm.
And then the benefit now is I can go and raise for other people without having a job.
Yeah.
And I can just focus on what I'm really, really good at, right?
Hmm.
And that is investor relations, building relationships, finding really good deals to help people invest in.
Yeah, this is more for the listeners. I mean, the key there is if you're a co-GP, the broker-dealer laws, you have to have a role in the company. If you do the fund-to-fund route, you're investing money, and that rule to be, a member of actually have a job, like Senate said, is no longer applicable because you're coming in as a fund manager here. So, all right. So the first one, accidental. And then it sounds like you decided to do that over and over and over again.
Yeah. So I actually went out and I set up my own fund. It's called a flexible fund,
Hmm.
where I can put multiple different assets inside of one fund.
Hmm.
And every one of them is siloed and protected from each other. So if something happens to this multifamily deal over here, it's not going to impact my debt deal over here or
Hmm.
my development deal over here. But so I have one fund, so it saves me a ton of money on legal expenses.
Hmm.
And I can spin up a deal in a day and be able to legally raise capital for it inside of 1 day.
Yep.
And what you were talking about is the fund to fund model. So what happens is I'm working with investors that have bigger minimums, right? So let's
Hmm.
just say the one I'm about to do, that I'm going to do an oil and gas deal next, and it has a
Yep.
$1 million minimum, right? So they'll take money from anybody.
Mhm.
I'm not that special, but but it has to be $1 million check.
Yeah.
And so what I do is I go and find, say, 20 investors at 50 grand,
Hmm.
and I pool them together to come up with this $1 million check. And because it's $1 million minimum, the terms are really, really good for me. And
Yeah.
if there's enough money in there to pay me and give amazing returns to my investors.
Yeah, that's absolutely crucial, and I think it helps everybody involved, especially if you're raising capital. I mean, the benefits to you if you're raising capital for the fund of funds, and you're only going to raise capital is compliance is easy, number one. Number two, you don't have to keep a job. You don't have to continually be part of that general partnership. And, number three, you can get slightly better terms if you're pooling people's money and bringing it to the table. So,
Absolutely.
what did I miss as far as advantages? I know there's lots of advantages to it, but those are the three main
You
ones. So,
really hit the nail on the head there, right? Compliance is the best thing. And, I'm not in the weeds of the operation.
hmm.
Like that unit I told you about, the first syndication,
Hmm.
just last week, there was a fire, right? So in the middle of the night, I get this phone call,
Yeah.
your building's on fire. I'm not going to get that as a fund to fund manager because I'm just an LP, right? My LPs, my investors in that deal,
Hmm.
they found out about this fire after the problem was solved,
Yep.
after the remediation has already been mostly done, you
Hmm.
know, and they're like, they say, oh, there was a fire and Senate and his team took care of it. That's what they
Yeah.
know. And so
Super
I
simple.
don't have to worry about that anymore.
Let's look at a different scenario how this could be advantageous. If you just invest $50,000 as a one person investor versus, a fund manager that brings $1 million to the table, do you have better access to
Sure.
the lead sponsor than a single investor or not?
Well, I like to say that I treat every investor the
Uh-huh.
same,
Yep.
whether they bring me $1,000 or $1 million.
Yeah.
I give them all my cell phone number and they all
Hmm.
get the same level of access, right? That's what I say.
Yeah.
And it is kind of true.
Hmm.
They're all equal, but let's be honest, some investors are more equal than others. You know,
Yeah. Yeah.
I've got one gal that has invested with me now 9 times,
Hmm.
an average of $100,000 per investment.
Yeah.
So this one person's given me $1 million.
Hmm.
If that person calls me at 2 in the morning, I'm probably answering.
Yeah. That is true. I'm looking at this from like an LP. An LP invests with you. I mean, you're going to be giving them attention, but if you're investing in the big fund, you're probably got a little bit more traction with the lead sponsor if you need it, right?
Yeah.
So, yeah.
And the big difference is on the front end.
Uh-huh.
So we haven't really talked much about due diligence yet, right? And
Hmm.
it wasn't really in the scope of this conversation. But
Hmm.
one of the big things that being a fund to fund manager has helped me do is it's
Yeah.
allowed me access to do more in-depth due diligence,
Hmm.
right? So, for example, I get my PPM and my deal presentation like everybody else, but I'm
Hmm.
also getting any kind of joint venture agreements, copies of all side letters, operating agreements for all the assets. I get copies of the loan terms, the loan
Hmm.
documents. I do background checks on all the partners.
Yeah.
And if somebody's only investing $50,000, first of all, they're not going to be given the ability to do that level of due diligence.
Hmm.
And it's not cost effective for them to do it, even if they could.
No, it's not. Absolutely true. Absolutely true. Ends up being a better product all around. Now, economics, I mean, most people listening are probably more interested in being you and setting up the fund as opposed to investing in the fund. What do your economics look like?
So, of course, every deal is going to be a little bit different, right?
Hmm.
But what I look for is I want to make approximately 3 to 4%
Hmm.
on the capital I raise per year.
Okay.
So, a 5 year deal, I want to make about 15% on the capital I raise. So, if
Hmm.
I raise $1 million, I want to make 150,000 over 5 years. So, I usually have a due diligence fee in the beginning, right?
Hmm.
So, somebody gives me an investment of say $100,000, I'm going to take three of that, 3,000 to
Hmm.
pay me to do all that due diligence we talked
Okay.
about. And then any cash flows that happen through the deal that I would receive count as well. But most
Okay.
of the time, because I'm paying out preferred returns, the investors get most of the cash flow during
Okay.
the life of the deal. Most of the time, that's how it works.
Yeah.
But then at the end, when it sells, then I make up that difference to get up to that about 15%. And I'm able to calculate all of that and project all of that in the very beginning based on
Hmm.
the sponsor's underwriting and the cash flows that they say. And
Okay.
then I just calculate how much I need to give to my investors.
Yeah. Okay. Yeah, it makes a lot of sense. And I mean, in a lot of ways, it's similar to how syndicators make money. I mean, you call it a due diligence fee, and in syndication, it's going to be an acquisition fee. And if the sponsor's paying it, I've brought fund managers into my deals, and amazingly, my due diligence fee is about equal to the acquisition fee that I would have paid out to a co-GP. But
Yep.
if you're good at raising money, you can make a good clip. So, yeah. Awesome, awesome. I think you called it a flex fund, right?
Flexible
So
fund. Yep.
flexible fund. So what are you allowed to do with that fund? I know we've talked about real estate already. You already mentioned oil and gas coming up. Who determines what can go into that fund? How do you set it up? And, tell us a little bit about all of that.
Great question. So of course there are rules, right? Like with
Yeah.
any syndication. So you have to choose a 506(b) or 506(c),
Hmm.
because what you're setting up your own syndication is really what
Yeah.
you're doing. But the funds also have another classification that you have to have,
Yep.
3C1 or 3C5.
Yep.
And I don't want to get into super technicalities of it, right? But 3C1 is when you're primarily raising capital for other people,
Hmm.
and 3C5 is when you're primarily raising capital for your own deals.
Hmm.
Okay. And again, primarily, you can do your own deals and other deals in both. So you have to make those choices first, but then you're going to write a PPM, just like you would on a syndication. And the PPM is what classifies what you can and can't do, right? So I intentionally made mine as broad as possible,
Hmm.
right? It's primarily focused on real estate, but allowed to do other things.
Hmm.
And so this PPM is so broad that I have done private equity deals. So we
Yeah.
bought paving companies
Interesting.
inside of this fund. I can do my own syndications. So
Hmm.
if I bought an apartment building last June, and the capital raise all went through this fund.
Hmm.
If I bought one tomorrow, the capital raise would all go through this fund again. I'm doing an oil and gas deal coming up next.
Hmm.
I've done a debt deal, so it's a private lending fund. I've also done a development deal and multifamily inside of it. And so when you set up a flexible fund, you're going to meet with an attorney, and that
Hmm.
attorney is going to help you do all of that and figure
Yeah.
out how it's set up.
I'll say a good attorney is going to help you figure it out.
Yeah, yeah. I mean, there's some good ones out there and some not so good ones out there. If anyone wants a recommendation for a
Yeah.
really good attorney, go ahead and give me a call. I'll tell you my experiences, good and bad. I don't
Yeah.
really want to call them out on a podcast, but uh,
Yeah, yeah,
privately, I'll tell you.
yeah, and I wouldn't ask you on the podcast as well because, don't want to talk trash about other people on the podcast. So,
No,
um,
but I will tell
yeah,
you who I would use
yeah,
for sure. And if you tell me you're going to use someone that I don't think you should,
hmm,
I would tell you why I wouldn't. But
yeah.
even then, I wouldn't say stay away from these people. I
Hmm.
would just say this is who I would call.
Yeah, 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 absolutely. And like I said, a good attorney is going to walk you through that, and a good attorney, I mean, you're going to pay for their time, obviously, but a good attorney is going to set you up for success. It's very helpful for somebody to know what they want going in. I set up a fund of funds a couple of years ago. I had a change of heart, and I've only, put two deals into that fund of funds, but I mean, I had made the decision prior to that I was only going to be doing real estate. And so my fund of funds, the PPM is set up differently than yours. I mean, it says real estate, it says multifamily plus other real estate, and then there is actually a little contingency in my fund just to make it tax efficient. I don't think I can bring in other deals, but they can't be more than 10% of the total allocated equity, right?
Okay.
There is some tax efficiencies in there as well. So, and I don't remember. I think I did a 3C1 fund. 3C1 and 3C7 seem to be the things that pop out in my mind. But anyway, that said, if you're interested in setting up the funds, how about this, Senate? Who should set up a fund?
So you should set up a fund,
Hmm.
you should set up a flexible fund like the one I was talking about. If you're expecting to do, let's say, more than 3 deals a year.
Hmm.
And if those are your own deals, quite honestly, or if
Hmm.
they're somebody else's deals,
Yep.
because there's a lot of management and it's fairly
Mhm.
expensive to do a
It is.
fund. But I've found that that's really the break even
Hmm.
number is 3 deals a year.
Hmm. Yeah, I agree. I mean, I did two deals in my fund several years ago, and every year, I've got to file my own taxes. There's, registrations. Now, the other thing is when you're raising money, if you're doing three deals per year in that fund, it works out for you. I forgot what I was going with that one, but the reason I only put two deals in there is because I was raising money for other people and decided that I want to be back in the driver's seat. So.
Mhm.
But yeah, looking at what you said, I'm still paying an accountant to file the taxes every year. I'm still paying registered agent fees. I'm still redoing my LLCs every year. Yeah, there are a bunch of expenses that I'm bearing essentially out of pocket right now.
Yeah.
But
I would
yeah,
I would challenge you to go back and look at that fund and see if
yeah,
you can put your next syndication in there. I mean,
yeah,
it is possible, right? And that's what I do. I put my
yeah,
syndications in there.
we did actually. And it doesn't work with the co-GP model,
Oh
right?
yeah, no.
So if I were syndicating all by myself, the answer is yes, I could.
Yep.
And it would save me money because I wouldn't have to, I already have the PPM. It would save me money on expenses on future syndications. But the way the fund is set up is I can't bring co-GPs in without going to another syndication attorney and setting up a syndication. So there's redundancy in there if I'm doing co-GPs. If I'm doing a capital raise 100% by myself, yes, I absolutely can. So, and that ends up being the big difference. And we did check it out, and that's what the attorney who looked through it told us. He's like, yeah, sorry guys, but
Yep, that's true. It's a good
yeah.
point.
But yeah, I mean, end of the day, I had a change of heart, which is why it didn't work for me. But had I kept on raising money, and I've raised a whole bunch of money for myself, but had I decided I wanted to keep raising money for other people, it would have made a big difference. So. All right. How about this? We're going to go into our last couple of questions. Question number one, what's next for you?
The thing that's really next for me is to move more into education, right?
Mm-hmm.
Something I really enjoy doing. I love teaching people and helping people. That's why I
Hmm.
come onto podcasts and things like that. I'm not sure which direction I'm going to go with that next, but I know it's going to be educational. I've done a ton of work teaching people how to buy apartments, and I've naturally done some LP or investor education,
Hmm.
but I've never really focused on that. So I just launched a free passive investing course.
Okay.
It's a 7-day email course, which it's like each video is about 5 minutes long, and you get an email once a day for 7 days of me talking about something that would be interesting to passive investors.
Hmm.
So for your audience, right, it would be valuable if they want to be a better passive investor and or if they want to learn how to talk to passive investors and what is interesting to passive investors.
Hmm.
And I'm going to do more and more of that is
Okay.
more passive investing work, I think.
All right.
Education.
Well, we'll put a link to that in the show notes if you're okay with that. And
Absolutely.
anybody who's interested can check that out and see what that passive investing course looks like. All right. Next question. If you had to give advice to somebody who's just starting out in multifamily, what would that be?
Hire a coach.
Hire a coach. Boom. Yeah, I couldn't agree more. And oh, by the way, there's two coaches on this podcast right now, and
Yes.
find one that you like and you get along with.
Right.
So that's definitely true. I mean, if you have a coach that you don't like and you don't get along with, you're probably not going to get much out of it. So,
Yeah. The
um,
other suggestion I would have on the coach that you have is they have to be aligned with where you're going.
yeah,
Right? And I think, Brian, I've been through your program, right? You're one of the mentorship groups I've been through,
yeah.
and you have a great program. And so if somebody wants to do what you've been doing, you're a
Yeah.
great fit, and I highly recommend your program. I've sent several people your way.
Thank you. Appreciate that. Yeah. And I know you have. I would say, as far as alignment, yeah, find somebody who's where you want to be. And that really helps. And I'm not going to coach anybody on sending up funds of funds because, mine didn't do awesome. Right. But I kind of stopped doing that. But, find somebody who's able to coach you on what you want to do, who aligns with you, and, things are going to go a lot faster. All right.
Absolutely.
Last question. How can listeners learn more about you?
My website is senateeskridge.com, but the
Yeah.
best thing you can do is go to meetsenate.com.
Hmm.
On there, you've got that passive investing course is on there. My most current deal is always on there. You can even book a call with me right there on that website. So
All right.
meetsenate.com.
All right, meetsenate.com, and that's where that passing investing course that he mentions at. So if you're interested, tap, swipe, tap, and assuming you're listening on your phone. I mean, most people listen to podcasts on their phones, but anyway, Senate, thanks so much for hanging out with me for a little bit today, and very much appreciate your time.
Yeah, thanks for having me, Ryan. It was great to see you again, and I really enjoyed our chat. I didn't even realize the time had gone so far,
I
so
know, I
fast.
know. I thought, yeah, time flies when you're having fun.